Have you ever wondered how Warren Buffett, one of the world's most successful investors, makes his investment decisions? Today we'll embark on a journey exploring the investment strategy of the Oracle of Omaha, the man who transformed a failing textile company into a global conglomerate worth hundreds of billions. Warren Buffett's story begins in Omaha, Nebraska. Born in 1930, Buffett displayed an early knack for business, making money as a child by delivering newspapers, selling golf balls, and owning pinball machines. His fascination with numbers, and a book he discovered at the age of 7, titled 1,000 Ways to Make $1,000, set the stage for his investment journey. Buffett's investment philosophy took shape under the mentorship of Benjamin Graham, the father of value investing. Graham taught Buffett to view stocks as more than just ticker symbols. They represent ownership in a business. This perspective serves as the foundation of Buffett's long-term value investing approach. He looks for companies with strong fundamentals, a competitive edge, and a management team that can be trusted. One concept that Buffett borrowed from Graham is the margin of safety. This principle involves buying a stock for less than its calculated intrinsic value, providing a buffer against unforeseen market volatility. It's like buying a dollar bill for 70 cents. A strategy that minimizes risk while maximizing potential gains. Buffett also emphasizes the importance of investing within one's circle of competence. This means sticking to industries and businesses that one understands deeply. If a business's operations or industry is too complex to grasp, Buffett suggests passing on that investment opportunity. This strategy helps to avoid poor investment decisions based on incomplete or misunderstood information. Another cornerstone of Buffett's strategy is his focus on economic moats. He is drawn to businesses with a sustainable competitive advantage that protects them from competitors. These moats can come in various forms, such as strong brand value, cost advantages, network effects, or regulatory barriers that deter competition. Buffett's philosophy also includes a contrarian approach to market sentiment. He encourages investors to be greedy when others are fearful, and fearful when others are greedy. This perspective allows him to capitalize on market downturns and panics, scooping up quality stocks at discounted prices. Lastly, Warren Buffett is a staunch advocate of patience and discipline. He often highlights the importance of ignoring short-term market noise and staying invested for the long haul. Some of his investments have been held for decades, demonstrating the power of compound interest. So, there you have it, the story of Warren Buffett's investment journey, and the key principles that guide his investment strategy. These principles of value investing, understanding your investments, seeking a margin of safety, looking for economic moats, contrarian investing, and maintaining patience and discipline, serve as a roadmap for anyone seeking to emulate the Oracle of Omaha's success. Remember, investing isn't about getting rich quick, it's about consistent growth over time. As Buffett himself says, someone is sitting in the shade today because someone planted a tree a long time ago. Till our next financial journey, keep your investments growing and your knowledge expanding.